Hello friends, how are you? Welcome to the Economics of Finance Excellency batch. So if you are watching it for the first time, please do not forget to subscribe to the channel, and all those who are watching this video, guys, please like the video because that is the biggest motivation for us. Okay, so what we have been doing in the last lecture, we discussed about the various components. We started with the various components of national income and we discussed about the first component, that is GDP at MP, and I hope that is clear to all of you. Whatever we have discussed in the GDP at MP, we discussed that it is a measure of market value of all the final economic goods and services without subtracting depreciation produced within the domestic territory of a country during the given time period, right? That any manufacturing which is done within the domestic territory of a country, whether it is being done by an Indian or whether it is done by any foreign company, any foreign national, if the manufacturing of the goods or the provision of services is being done within the domestic territory of a country, then that is included in the GDP of that country where the production is taking place. Okay, so GDP at MP is a value added concept, value of output in the domestic territory minus the value of intermediate consumption, as we have already discussed, right? So GDP at MP is sum total of value addition. Value addition means what is the value that you are adding to a product. That is why this intermediate consumption we are removing. Clear? Why it is being removed, we have already discussed it in the last lecture. Then we discussed about the exclusions, that what all are the exclusions from GDP at MP. Then we discussed about nominal GDP and the real GDP. Nominal GDP is GDP calculated at the current year prices, whereas the real GDP takes into account the base year prices. Now, real GDP gives a more realistic picture, right? Because when you are going to compare it with the base year, when the prices are same, if the GDP is increasing, then that increase will be only and only due to the number of units being manufactured, which shows the real growth of the economy. Otherwise, we can't really say the economy is growing, right? So I hope this much is clear to guys. GDP deflator is the nominal GDP divided by real GDP into 100. That shows the inflation, that how much there is a price increase, right? Real GDP is the base year, nominal is the current year. So it shows what is the price increase from the base year till the current year. That shows the inflation, right? Okay, so now what we are going to do is we are going to do one or two practical problems. 2-3 practical problems are there in the institute module regarding this nominal and real GDP. So we are going to do that, right? Let's see. So illustration number 1 is there because as I promised that we will be doing all the illustrations of the ICAI mat. So illustration number 1, find out the GDP deflator interpreted. So they have given the years, year 2014 onwards till year 2019. The nominal GDP is given, the real GDP is given, and you are required to calculate the GDP deflator. Now this 2014, this becomes our base year. This becomes our base year, right? Now in the base year, he says the nominal GDP and the real GDP must be same. We have discussed it in the last lecture also, right? Because in the base year, in the nominal GDP, we are taking the base prices. In the real GDP, we are taking the base prices. So it will always be same, right? So what is GDP deflator? Nominal GDP divided by real GDP multiplied by 100. So in the base year, the GDP deflator will always be 100. Clear? Now, in year 2015, the nominal GDP is 800, the real GDP is 650. That means, according to the base year prices, the GDP is 650. But according to the current year prices, the GDP is 800. That means there is a gap. There is an inflation gap, right? So what is that? 123%. Now, what is this 123%? 800 divided by 650 multiplied by 100. Similarly, in 2016, the real GDP, that is the GDP based on the base year prices, that was 800, whereas the nominal GDP, that is GDP as per the current year prices, that is 1150. Again, now 1150 shows that there is an increase in the prices. That is why there is an increase in the GDP. So it has again increased. 1150 divided by 800 multiplied by 100. Similarly, for 2017, they have calculated, that is 1300 divided by the real GDP multiplied by 100, and here also it's 1550 divided by 1190 multiplied by 100. Here 1700 divided by 1240. Clear? Now, what is the interpretation? The interpretation says, notice that we use 2014 as the base year prices to compute the real GDP of the subsequent years. The real GDP has risen over the years from 500 billion in 2014 to 1240 billion in 2019. He is talking only about the real GDP, right? That if we can notice that the real GDP has increased. Definitely, it has increased from 500 billion to 1240 billion, right? But he says this indicate that the increase is attributable to an increase in the quantities produced. I just told you that when the real GDP is increasing, because the prices are constant, the price we are taking is for the base year only. If the GDP is increasing, that increase is due to only and only the increase in the quantities, right? We have discussed with the example also. After that, he says, because the prices are held constant at base year. A deflator above 100 is an indication of the price levels being higher as compared to the base year. That is what I told you, right? From year 2015 to year 2019, we find that the price levels are higher than that of the base year. When he is talking about the nominal GDP, the highest being in the year 2016. So in the year 2016, right, it was 143.75%, which is the highest, right? If the GDP deflator is greater than 100, then the nominal GDP is greater than real GDP. If the GDP deflator next year is less than the GDP deflator this year, then the price level has fallen. It is if it is greater, the price levels have increased. Sir, simple. If the GDP deflator is more than 100, then that means the prices have increased, right? And if the prices have increased, the nominal GDP will be more than your real GDP. Clear? Just try to understand what he is saying. He says if your GDP deflator, if your GDP deflator is more than 100, right? More than 100. Then what does it mean? It means there is an increase in prices. There is an increase in prices. Now, if there is an increase in prices, what will happen, sir? If there is an increase in prices, what will be higher? Your nominal GDP. Your nominal GDP will be more than real GDP. And vice versa. Vice versa means if the GDP deflator is less than 100, if GDP deflator, you can write it down in the books, is less than 100, then that means there is decrease in prices. There is decrease in prices. That means your nominal GDP will be less than your real GDP. Clear? So this is the basic interpretation. I hope this is clear. The first example. With this, the GDP inflator will be more clear to you, right? Okay, let's move on to illustration number 2. The nominal and the real GDP respectively of the country in a particular year are 3,000 crores and 4,700 crores. Calculate the GDP deflator and comment on the level of prices of the year in comparison with the base year. Now, what is he saying is, what is your nominal GDP? That is 3,000, right? And what is your real GDP? That is 4,700. That means the nominal GDP is less than your real GDP here, isn't it? That means, what does it mean now? If the nominal GDP is less than real GDP, one thing we can easily find out that the GDP deflator will be less than 100, right? The second interpretation is that the prices have reduced. Prices have reduced, isn't it? So these two interpretations are very easy to make it from the figures itself. So we say the nominal GDP is 3,000 crore, real GDP is 4,700 crore. So GDP deflator will be nominal GDP divided by real GDP multiplied by 100. That is 63.83%. The price level has fallen since the GDP deflator is less than 100 at 63.83%, right? That is what we are saying. That GDP deflator less than 100, the prices have reduced. Any doubts? Very simple part. Let's move on to illustration number 3. Now it says find the nominal GDP if the real GDP is 450 and the price index is 120. Now what is this price index, sir? What is this price index? This is nothing but your GDP deflator. This is nothing but your GDP deflator. So how will you calculate? How will you calculate this? We say GDP deflator is equal to nominal GDP divided by real GDP multiplied by 100, right? Now, what is the requirement? What do you want to calculate? You want to calculate this nominal GDP. So, how will you write this? How will you write this? If you want to calculate this nominal GDP, we can say nominal GDP is equal to real GDP, right? Real GDP multiplied by GDP deflator divided by 100, right? I'll take it here, multiply it here, and 100 I will take it in the denominator. So this is how the nominal GDP can be calculated. So what is price index? Price index is nothing but the GDP deflator. Why it is called a price index, sir? Because it shows why it is being called a price index. You should know it, that this word has been used. Why this word has been used? Why not GDP deflator, sir? Right? Why this price index is called GDP deflator? Because what does the GDP deflator shows? It shows the increase in the prices. Right, so it is indicating what? It is indicating the change in the prices with the base year. So that is why it is also known as price index, right? Okay, so this was the nominal GDP is equal to real GDP multiplied by price index by 100. So this is how the nominal GDP has been calculated, 540. Now one thing, here the price index, that is GDP deflator, is greater than 100. That means our nominal GDP will be higher than 450. Because the prices have increased. Because the prices have increased, the nominal GDP will be higher. Let's move on to illustration number 4. Suppose the nominal GDP of the country in the year 2010 is 600 crores and the price index is given in the base year is 100. Now let the nominal GDP increase to 1200 crores. It is GDP here, right? Not GNP. He says now let the nominal GDP increase to 1200 crores in the year 2018 and the price index rises to 110. That means there is an increase in the nominal GDP. Our GDP deflator has also increased beyond 100. That means there is an increase in the prices, right? Because the nominal GDP has increased from 600 to 1200 crores and it is attributable to increase in the prices. Find out the real GDP. Now again, what we say, GDP deflator is equal to nominal GDP divided by real GDP multiplied by 100. Now we want to calculate this. So what I will do is, I'll take it here and I will take it in the denominator. So real GDP is equal to nominal GDP divided by GDP deflator multiplied by 100, right? So what is nominal GDP here? What is nominal GDP? 1200. So I'll say 1200. What is the index here? 110 multiplied by 100. That comes to 1090.9 crores. Clear? This is how the real and the nominal GDPs can be calculated, and these questions can be asked in the examination for 2 marks. For 2 marks, these kind of small questions can be asked. Clear? I hope the concept is now clear. What the nominal GDP has to say, what the real GDP has to say, all these things are absolutely clear, right? So with this, the GDP at MP part is over. GDP at MP part is over, right? This was all to be covered in GDP at MP. Now we are moving on to the next component. What is the next component, sir? The next component is gross national product at market price. Now, what is this gross national product? Again, we are going to take a few things. One, the gross thing. Another thing that we are going to take it is the market price. And now here the third thing that we are going to take is national. First we have done the gross domestic product at market price. Now we are saying gross national product at market price. Two things are absolutely clear. When he is talking about gross, when we are saying gross, then that means there is no subtraction of depreciation. One thing is clear, right? When we are talking about price, that means we have to take the market price of economic goods and services, that what is the price of that goods in the market. Clear? Now, what do you mean by this national, sir? In the domestic part, in the previous part, in the gross domestic product, what we are saying, we are saying that anything which is being manufactured within the domestic territory of the country, right? Any income, any goods or services which are being done within the domestic territory of a country. Now, when we are going to the national thing, that means something from outside the domestic territory has to be included. Clear? So when we are talking about gross national product at market price, in the domestic we say within the domestic territory. Now when we are saying national, that means something from outside the domestic territory has to be included in our national income, right? Okay. So he says, for the computation of GDP, the value of goods and services produced within the domestic territory of the country, whether by residents or by non-residents, are considered. That we have already studied for the calculation of gross domestic product. Now he says, when we have to take something from outside, what is that? He says, there will be the nationals who will be earning the income outside, but they will bring that income to our country, which will form the part of national income of our country, which is known as gross national product. That any income flowing to our country from outside, because our national, let's say an Indian national has done a project in the USA and he has earned $5,000 there, right? So what he will do with that $5,000? Is he going to leave that in the USA? No, sir. He will be bringing that $5,000 to India. So that is what? That is, now when he is bringing that $5,000 to India, he will be spending in India, right? There will be money circulation, money rotation in India. That will contribute to the growth, that will contribute to the demand in where? In India, right? So if there is any income from outside which is being earned by our national, and that income will come back to India. Now, sir, there is another scenario. Sir, if there is any national who is earning in India and he will take the income outside, then what will happen, sir? That is why we are taking this term. For the computation of gross national product, along with the above value of goods and services, the net factor income from abroad is considered, right? It is again evaluated at market price. What is net factor income from abroad? Have we done that? Have we done the net factor income from abroad? Remember something, that any income which the normal resident of a country, right, earns from the rest of the world, right? An Indian national providing the services in USA, he will be earning the income in USA, he will bring that income back to India, right? He will create the demand in India because he will be spending that money in India, right? On the other hand, if there is a national, if a foreign national comes to India, provide the services, earns in India, right? He will be taking that money back to USA, right? He is not contributing anything in India. So we have to subtract that. Clear? That is why we say that when we are talking about the national income, gross national product at market price, it is GDP at MP. Anything which has been manufactured within the domestic territory of our country, it has to be taken. But something which is earned outside, but it will be brought back to our country, we have to consider that also, right? So net factor income from abroad, it is to be included. What is net factor income from abroad? Factor income from abroad minus factor income to abroad, right? FIFA minus FITA. Now this FIFA is not World Cup FIFA, right? Now many will say, sir, World Cup FIFA. No, it is not World Cup FIFA. It is what? This is not a football one. This is foreign income. This is what? Factor income from abroad. Clear? I hope this is clear. Now let's take one or two examples to clarify this thing. I've taken these examples, right? These examples are not there in the institute mat, or we will not find it anywhere. because these are my created examples for your clarification. That is why I say that you must be having these economic books. All those who want to order, the website link is there on your screen at the bottom, www.ksjteaching.org. Go for a small investment and you will get the books, right? PDFs free, not available, sir. Right? This is just a minimal investment. Everything can't be provided free of cost, sir. That you people need to understand this thing, right? Otherwise, tomorrow you will also be free. You will also be sitting absolutely free. Okay, now what is the first example says X Limited, an Indian company, produced goods in Japan worth rupees 1 lakh. Now what will happen, sir? First thing, will this be added in the GDP at MP? Don't look at the answer, but just try to focus on that. There is an Indian company, X Limited. It has produced goods in Japan, right? Has the manufacturing being done within the domestic territory of India? No, sir. So will that be included in the GDP at MP? Absolutely no. Why? Because the goods have not been produced within the domestic territory of India. Understandable, right? That is what I have written. I said no, as the goods have not been produced within the domestic territory of a country. So GDP at MP is not in question. Now he says, will this value be included in the GNP at MP? Now what will happen, sir? An Indian company produced the goods in Japan worth rupees 1 lakh, right? They will sell the goods in Japan, right? Then earn 1 lakh, and come back to India. Now what will happen, sir? Will this be included in the gross national product? Obviously. Why? Because they are earning in Japan by selling those goods and they are bringing that money to India, right? That money will then be invested in the India. That money will then be used in the Indian market to create more demand, to create more goods and services, right? So it forms a part of your net factor income from abroad. Clear? Right. Then example 2. He says Y Limited, an American company, produced goods in India worth rupees 1 lakh. So there is an outsider. There is an American company which comes to India, manufactures goods in India worth rupees 1 lakh. Now, will this be included? Will this be included in the GDP at MP? Obviously, sir. Why it will be included in the GDP at MP? Because the goods have been manufactured within the domestic territory of a country, right? So it will be included in the, yes, in the GDP of India. GDP of India. So he says, yes, as the goods have been produced within the domestic territory of a country. Country means India. Now, my next question to you is, will this be included in the GNP at MP? Will this be included in the GNP at MP, sir? A foreigner is coming to India, earns money. Now, what he will do with this 1 lakh? He will take this back to USA, right? He will take this back to America. He will spend there. He will, create the demand there. So, is it a part of gross national product at market price in India? No, sir, right? Because this money will be flowing back to America. Okay, so will this be included in the GNP at MP? No, as the income earned from these goods belong to a foreign company and therefore will be subtracted while calculating the net factor income from abroad. Clear? I hope now the concept is better. Gross national product at market price. So whenever we are talking about the national product, one thing that forms the part is anything which is manufactured within the territory of India, right? Within the territory of country, any country, because GDP is applicable to all the countries, sir. It is a common economic fact, right? It is not only limited to India, that GDP is only for India. No, it is the overall in the world also the concept remains the same. So GDP is what? GDP is any goods or services being provided within the domestic territory of a country. When we move on from the domestic part to the national part says you have to include any income which is flowing from abroad to India, right? By an Indian resident, if he is earning something abroad, then that income he will bring back to India. He will create a demand in India. He will invest that money in India. So it should form the part of the national income of India. Clear? So this is gross national product at market price. Now the next concept is net domestic product at market price. Net domestic product at market price. Now again we are going to circle it. The first thing is the net, second thing is the domestic, and the third thing is market price. Now in this thing, what is changing here? Market price remains the same, that is market price of all economic goods and services, right? All economic goods and services. Domestic remains the same, that all those goods which are being produced within domestic territory, within domestic territory. Clear? Now here, instead of gross, we are taking the net value. Instead of gross, we are taking the net value. So he says it is the value of all the goods and services produced within the domestic territory of a country by the residents or by non-residents. This concept is related to the domestic part, so it remains the same, that any goods and services produced within the domestic territory excluding the depreciation. Now depreciation is what? Depreciation is my capital consumption. He says you are manufacturing goods, that is absolutely good, that is absolutely fine, but at the same time you are consuming the goods also. What is consumption? Which goods are you consuming? Sir, machinery wear and tear, that is depreciation. So he says you have to remove what you are consuming in the form of the wear and tear, the capital consumption, that is known as depreciation. So he says whenever we are talking about the net value, you have to take the value of goods and services minus the capital that you have consumed in the form of depreciation, right? So NDP at MP is GDP at MP, gross minus depreciation. Sir, obviously remember one thing, as I told you about the trading and profit and loss account. Okay, I'll check that where I have discussed with you regarding that trading and profit and loss account. Here, right? Now, if you want to calculate this net profit, what will you do? You will say gross minus depreciation, gross minus depreciation. So this is what is being done here, right? Gross minus depreciation is what we are doing here. So NDP at MP is GDP at MP, that is gross minus depreciation. So NDP at MP does not consider the capital consumption during the production process, that we are excluding the depreciation, right? Then points to remember, net value is equal to gross value minus depreciation. That is what we have written here. Clear? So this was a very small concept, net domestic product at market price. Now on the same lines, we have the next one, that is the net national product at market price. So what is there? Net is there, then national is there, and the market price is there. Now what happens, sir? Market price remains the same, that is market price of all economic goods and services. Now what is net here? Net means gross minus depreciation. Now first what we have done is we say the net domestic product at market price. Now we say net national product, that means domestic plus net factor income from abroad, right? National product, that is what we say in the concept of national, that something, the income by the residents of a country which is flowing from outside the country. So that is what is done here, that NNP at MP, we call it as NNP at MP is equal to NDP at MP, that is the domestic part, plus net factor income from abroad. Or I can also write it as gross national product minus depreciation, because in that, what is there? This NP is same, national is same, and the market price is same. What is changing? From net, from gross to net. So if you want to go from gross to net, what do you do? GNP minus depreciation. Or we can write it as NNP at MP is equal to GDP at MP, right? Minus depreciation. That will lead to NDP at MP. This will become my NDP at MP, right? Now, if in the NDP at MP, I add net factor income from abroad. So why these different formulas have been given? Because in the question, you don't know what kind of information will be given to you. So depending on that, these formulas have been given. So point to remember is national is equal to domestic plus net factor income from abroad. We have already discussed about it, right? So the same thing, everything is same, sir. The same thing can be written in the different ways, right? GNP at MP, and then GNP at MP might be given to you. GNP at MP we have just done, right? If from the gross to national, you need to remember these two things. If you want to go from gross to net, you have to reduce the depreciation, right? That is why I've given these points to remember. And if you want to go from national, if you want to go from domestic to national, you have to add the net factor income from abroad, right? Rest everything will automatically fall in place. Clear? Any doubts? Now, what is factor cost? We have already discussed about factor cost, sir. Refers to any payment made to the factors of production with land, labor, capital, and entrepreneurship. We also call it as the income of the factors of production. We have already discussed about it, right? Land is income from rent, labor, wages, salaries, capital, interest, entrepreneurship, profits. Then he says, what is market price? What is market price? We have been saying GDP at market price, NNP at market price, right? So as I told you that market price is any price that you will be fetching in the market. Now this price will, what will have? This price will have the basic cost that you have paid on the manufacturing of that good or providing of services, the cost that you have incurred, and it will include your taxes also, isn't it? When you will be selling the product, you will be adding the taxes also. Right, sir? Absolutely right, sir. So market price refers to the final money value of all the goods and services, that is net value added in the course of production of goods and services. Final money value, right? Market price includes indirect taxes and exclude the subsidies and grants received from the government. Obviously, when we talk about, as I told you, when we are talking about this market price, the market price will have the taxes, right? And if there are any subsidies or the grants being received against your product, that will reduce my final value. That will reduce the market value. Obviously, sir, that will reduce it, isn't it? So this is the market value. Now it says, what is net indirect taxes? There is a term being used here, that is a net indirect taxes. That means the total indirect taxes minus if there are subsidies that you are getting from the government. So this subsidy is what? This is a benefit that you are getting. We can say this net indirect taxes is a cost. Cost minus benefit, that is what? Cost minus benefit is your net cost. That is what is written here. So net indirect taxes is equal to total indirect taxes minus the subsidies. Now, what is market price? Market price, in the market price, he says, what is the cost of the factors of production? That means this is the cost that you have incurred in the manufacturing of that good or in the providing of services. This is the cost. In that cost, you will add the taxes also. Which taxes? You will add net indirect taxes, right? Not only indirect taxes, what we are adding? We are saying cost of the factors of production plus net indirect taxes. That means the indirect taxes minus the subsidies. So we have to take the net indirect taxes. Clear? After that, it says, what are indirect taxes, sir? What are indirect taxes which are not directly on your income? You all know, right? Indirect taxes include the product related taxes which are related to the product, like the GST, custom duty. It is related to the product. These taxes are related to the quantity and the value of the goods produced. For example, GST, custom duty, etc. We all know this. I don't think so there is any explanation required for that. The second is production related taxes. Production related taxes. These taxes are paid either before or during the production process but are unrelated to quantity and value. These are the taxes which are not based on the quantity or the value of the goods, but still you are paying it because you are producing something. For example, the factory license fee, taxes paid to the local authorities. So all these are what? These are not related to what you are manufacturing, how much you are manufacturing, what is the value that you are manufacturing. No, it is not dependent upon that. It is dependent on the fact that you are manufacturing. That's it. Pollution control fee can be there. You are manufacturing, your factory is manufacturing, and the pollution authorities will come to you that you need to pollution control, license, so that you are not destroying the environment, right? So all these things are what? All these things are indirect taxes that you are paying. It is not a direct tax being on your income. No, sir. It is an indirect tax that you are paying, but it is not related to your product. It is related to the production. Product, the tax which is related to the product, that is based on the quantity and the value of that product. Clear? So after that, from next topic, we'll continue it in the next lecture. Gross domestic product at factor cost, then net domestic product at factor cost, right? And then finally we will reach to net national product at factor cost, that is the national income. This we'll cover up in the next lecture, and we will be doing the further practical problems also which we have in the institute mat related to this GDP and all those things. We'll be doing the practical problems also, right? So see you guys in the next lecture. Till then, stay safe, stay healthy, keep studying, keep sharing. Thank you so much.